In my podcast today, I want to share with you 5 property predictions for 2025 most experts are going to get wrong. And then I want to share with you 12 rules to make 2025 a great investment year for you. So welcome to another episode of the Michael Yardney podcast, where I try and create clarity amongst the chaos of all the mixed messages in the media so that you can develop the financial freedom you deserve. Now, regular listeners or viewers of this podcast would know that I usually have a guest with me, but every now and then I do a show, just you and me, when I want to get a special message across, and this is one of the shows. So I'm going to make my predictions and give you some ideas and advice. Now, regular listeners to this would have heard some of the advice and some of the rules I'm going to share with you, but please, when you listen to those, have a think, hey, I've heard Michael say that before, but how am I actually using those? Am I using those? How can I improve on using those? So thank you for joining me. Let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
This time of the year, it's customary for those of us in the property industry to peer into the future in an attempt to predict what's going to happen to our housing markets. And while making forecasts isn't exact science, I can safely make 5 predictions that I'm certain are going to be true in 2025, and I'd like to share those with you to start with. Then I've got some other fun stuff to talk about as well. But the first prediction I'm going to make, and I'm sure I'm right, is that most predictions will be wrong. It's going to be a bad year for those in the prediction business. And I'm sure this is going to be correct, as most economic and property experts get it wrong, despite being armed with all the research available in today's information age. The problem is, while the fundamentals, things such as population growth, supply and demand, employment levels, interest rates, affordability, inflationary pressures, they're reasonably easy to monitor. One overriding factor that all the experts just can't quantify is investor and consumer sentiment. Currently, sentiment's low, particularly investor sentiment. In fact, it's the lowest it's been for a while, despite our general economic fundamentals being strong. But I also see that this is going to change in the second half of the year once the federal election's over and once interest rates start falling. Another prediction I want to make for this year is many things won't happen and others will. Many of the predictions for 2025 won't happen. A lot of things will happen this year that no forecaster thought of to include in their predictions, because market movements are far from an exact science. Every year there's an X factor, something that you've heard me talk about before, a black swan event. It's something unpredictable, either locally or from abroad, that affects our markets positively or negatively. However, in retrospect, these unexpected events will seem to be obvious consequences of the current economic and political environment. Last year, no one predicted interest rates would remain so high for so long, or that we'd have a per capita recession for one quarter after the other 8 quarters now, or the cost of living crisis would affect so many Australians, and very few believe that the war in Ukraine or the Middle East would last that long. I might even talk about the predictions people made last year about the American president. The next forecast prediction I'd like to make for this year is some forecasts will be right. Now, I'm not trying to be smart, but I predict a small number of the many economic and property forecasts are going to accidentally come true. And those who randomly predict them are going to claim to be experts, despite the fact it was the first time they got one of their hundreds of forecasts right, and that they adjusted their forecasts over the year circumstances unfolded. Just look how, well, the Reserve Bank, I guess it's a bit harder for them to forecast, but all the banks forecast, and the various property commentators changed their forecast time and time again last year, didn't they? Next prediction is most property investors are going to get it wrong this year. Now, this is a simple one because they always do. I'm not talking about those who failed to take action this year, those waiting just for things to be just right before they get in the market, even though that'll be a big mistake. I'm talking about what data, I guess, that shows that 20% of those who invest, interestingly, sell up in the first couple of years. Around 50% of those who buy an investment property sell within 5 years. These failed investors never gained the long-term wealth creation benefits that property investment's all about. And the fifth prediction I want to make for you today is that those who get it right will do very well. Those who take advantage of this stage of the property cycle. Now, those who saw previous quiet spells like we're currently experiencing, those who saw them as counter-cyclical opportunities have consistently done well for themselves. So I'm not suggesting invest in those areas that have had 3-4 years of growth. Now, Perth's had 4 years of growth. Property cycles don't continue that long. Some markets are near their peaks. But there's other areas that are out of favour at the moment, like Melbourne, where I believe over the long term there are some good, strong long-term fundamentals. The investors who take advantage of this recognise the slower market as a chance to, I guess, invest when others are afraid to buy and when there are more willing sellers than there are purchasers. However, not all investors who buy during the quieter time are going to get it right. That's because you can't just buy any property and expect it to outperform in the long term. The key is to buy the right property in the right location. And at this time of the cycle, correct asset allocation is going to be even more critical than ever. I mean, if you think about the property boom we had, the once-in-a-generation boom we had in 2020-21, every property went up in value. That's not how the market normally works. You need to buy an investment-grade property below its intrinsic value, one that's got a bit of a twist to it, something special about it, maybe the ability to add value to it. And I believe you should be, in general, if you can afford it, looking at the inner and middle ring suburbs of our major capital cities in locations that have historically had above average growth. Why? Because the value of property in good locations will continue to increase in the future due to scarcity. And when interest rates eventually fall and consumer confidence returns, an improving economy, jobs growth, population growth, and a shortage of the right type of property, as well as the significant infrastructure spending the governments are spending, will all have a positive impact on property. So there's 5 predictions that I think are going to be true. But let me share a couple more for 2025 with you. I think the upcoming federal election is going to ensure that immigration, housing affordability, and the cost of living are going to remain in the news. I also see this year as a year of 2 halves, with a quieter first half, and then the property markets are going to rebound when interest rates start to fall later in the year. I think it's going to be a year that vacancy rates remain low, and rents are going to keep growing, not as strongly as the last couple of years, but rental affordability is going to limit the capacity many tenants can afford to pay, so more are going to join together or move further out. And I also think this is going to be a year where the state governments are going to continue to introduce legislation favouring tenants and taxing property investors, which is unfortunately going to continue to motivate some investors to sell up. That's only going to make the rental shortage worse, isn't it? So the big question is, what's 2025 going to bring your way in terms of wealth creation and property markets? So I appreciate that you come and listen to this podcast or watch it now. A lot more people are watching it now that's on YouTube as a video. But if we could just keep talking a bit about what's going to happen this year and how you can take advantage of it, I guess it seems that anyone can be a property genius when the property markets were booming. But when time gets tough, like we're having a little bit at the moment, it's important to listen to those who've got the perspective, who've lived through a number of economic cycles and who take a holistic approach to wealth creation. And clearly we now are in interesting, I guess what some would call challenging times. We're living in a period of still relatively high interest rates. There's definitely economic uncertainty, geopolitical uncertainty, continual conveyor belt of negative messages in the media that's dampening consumer confidence. And with an election coming up, there's going to still remain the continual barrage of news about housing affordability, rental crisis, immigration, and why we should reform rental legislation. And while I'm confident about the long-term economic future, I'm not fooled into thinking that all our economic and business problems are over. Far from it. Now, don't get me wrong. I don't think there's going to be a property crash anytime soon. We never really had one in Australia, but I can clearly see headwinds that will slow the market down for the first half of this year, both local problems and overseas. And that's probably why I've been asked by clients in the media, what rules do I apply at times like this when the market's changing in front of our eyes? And I start by explaining that I've been investing for over 5 decades and I've amassed a very significant property portfolio that's made me financially independent. But interestingly, I still intend to remain active in the property markets, which means I recognise I'm going to still experience more market downturns and several more property booms. But I've learned not to change my strategy every time the economy or our property markets get challenged. You see, I invest for the long term, and I don't get thrown off by either all the good or the bad phases of the property cycle, because I know they're part of the cycle, the economic cycle, the property cycle. I recognise the ups and downs are in the short term, but the long-term trend for the 50 years I've been investing, the long-term trend since Federation has been for property values to keep increasing, and that's unlikely to change. And because it's easy to get caught up in the panic and drama of the moment, I've learned to turn down the noise and be careful who I listen to. I still listen to the media. I still have experts that I have advised us and our clients at Metropole, but in particular, I've learned not to listen to the mainstream media because I guess they're for the mainstream, not the small group of Australians who develop financial literacy. And I also know the job of the media is not to educate us, but to entertain us, to entice us, to click on the links with their seductive clickbait headlines. I mean, basically, you'll see those, and sometimes I get sucked in them as well, just to see what these funny commentators are talking about. So if, like me, you're investing for the long term, I'd like to share with you 12 rules to keep in mind to help you make it through to the other side. And the first one I'd like to share with you is to become financially fluent. The secret to financial freedom is to spend less than you earn, save the balance, and invest wisely in growing your assets. You've probably heard that before. I can't remember how many years ago, maybe a century ago, there was that book, The Richest Man in Babylon, who talked about that. And that nothing has changed in all that time. Learn how money, finance, and property works. Start investing early so you've got time and compounding on your side. And along the way, I suggest, if you're a beginner, learn from proven mentors and get a good team around you. But make sure you've got a thorough knowledge base, because while you can delegate or you can outsource many tasks, it's critical to understand if you're being given impartial advice or if you're being taken advantage of by the many vested interests after your money. Now, I want to give a disclaimer. At Metropole, we do give advice. My team do give strategic property and wealth advice, so we're much, much more than the buyer's agent, but they're using frameworks that I've fine-tuned over 5 decades, and we've been helping clients with for over 26 years. But while we advise our clients, I want them to actually have a knowledge base, and that's why we educate them, and why I'm happy to educate you through these podcasts and through my blogs. So in my mind, becoming financially fluent means you're much more likely to invest rather than speculate. One of the reasons most investors don't develop financial freedom, the financial freedom I think all Australians deserve, is because they don't understand the rules of money, and they end up buying their properties with emotion. Look, be it your first property or next property, it really's got to be part of a long-term plan and a stepping stone to build a substantial portfolio. But the problem is most investors buy with emotion. They're looking for property that they're happy to live in, or buy in suburbs near where they live, or near where they want a holiday, or near where they plan to retire. But of course, property investment is very different from buying your own home. You need a well thought out strategy with measurable goals. Having a plan and a system to gauge the worth of investment you're going to have is going to give you much better results. And that's why at Metropole, we always start by putting a plan together for our clients. We're much more than buyer's agents. So while buyer's agents will go off and buy property, and we have buyer's agents on the ground in each state, they don't fly in and fly out. They don't use FaceTime to speak to the selling agent and look at the property. We've got our own team on the ground. They implement the strategic plan that the planners do, and planners make for our clients, and it doesn't matter where we suggest you invest. So I believe you've got to adopt a proven investment strategy. That's the second rule I want to share with you. Remember, 92% of investors never get past their first or their second investment property. So don't follow the herd. Don't follow the strategy most property investors follow. And that's the strategy you'll hear on many podcasts or in many blogs. Buying an investment property is not a strategy. Residential real estate, in my mind, is a high growth, relatively low yield investment. So I recommend a capital growth investment strategy. I know cash flow is important. It keeps you in the game, but it's capital growth that's going to get you out of the rat race. So first, concentrate on building a substantial asset base over a number of property cycles. Then slowly you lower your loan to value ratios and eventually live off your cash machine. It's too hard to get rich the other way around from savings or cash flow. In other words, invest for the long term. Wealth, in my mind and for our clients and for me has been created by building a substantial asset base, and you achieve this by holding good investments for a reasonably long term, reinvesting your income, and allowing your capital gains to build up. Of course, there's much more to successful investment than just a strategy. You see, attaining wealth, that doesn't just happen. It's part of a plan. Planning is, I guess, bringing your future into the present so you can do something about it now. And as I think I started to explain, my team at Metropole helps investors by building them a personalised strategic property plan. Because when you've got a property plan, you're more likely to achieve the freedom you're looking for because it defines your goals. You see whether your goals are realistic, especially for your timeline. Boy, we see people who have unrealistic goals, and so therefore they're in too much of a hurry to try and achieve things they're never going to, and they make mistakes along the way. But then also having a plan helps you measure your progress towards your goals, whether your property portfolio is working for you or whether you're working for it by having bought the wrong properties. Having a plan finds ways to maximize your wealth creation, but it also identifies risks you haven't thought of. And the real benefit is you grow your wealth through your property portfolio safely and faster than the average investor. So let me ask you a question. Do you have a plan for your financial future? If so, does it contain the following components: an asset accumulation strategy, a manufacturing growth strategy, a rental growth strategy, an asset protection and tax minimisation strategy, a finance strategy, including eventually the long-term debt reduction, and a living off your property portfolio strategy? If not, why not have a chat with my team at Metropole to understand what our strategic property planning service does? Go to metropole.com.au and find out about how we can help you. Now, as I'm going through 12 rules to help you, I want you to remember that not every property is investment grade. So while you can make any property an investment, you kick the tenant out, kick the owner out, put a tenant in, investment grade properties outperform. And that's in many ways related to location. You know that location is going to do 80% of the heavy lifting. So it's important to own the right property and in the area where there's the correct demographic. Another lesson I want to remind you is don't believe the hype. Be careful who you listen to. There are some independent advisors out there, some great independent advisors out there. Sure, I'd love you to speak with the team at Metropole, but there are others there as well. But also the market's flooded with developers, property marketers, real estate agents, and so-called gurus who don't have your best interest at heart. So don't believe all the hype. It's too easy to get caught up in the panic and drama. I see all those messages on my social media as well, and I'd be very cautious about that. Oh, look, the next rule I want to quickly share with you is that location does the heavy lifting. I think I already explained that to you, that's the reason why I only invest in select suburbs in the three major capital cities of Australia. I know there's people going to tell you to invest in regional Australia or other locations, but why fight the big gorillas? Why fight the big trends? Over the next decades, most of the jobs, most of the wages growth, most of the population growth, most of the economy is going to happen in Australia's capital cities, and in particular in our three big capital cities. And the inner and middle ring suburbs will, over the long term, always outperform with regard to capital growth as they've done over the last decades. Interestingly, it wasn't always that way. At Federation, regional land was more valuable than capital cities. Just go to the big country towns and you'll see some huge properties, some huge estates that were there. But then when we industrialised as a country and people moved to the city became more valuable. And now we no longer manufacture goods. It's all about services. And that's where higher paying jobs are. And these people have more disposable incomes. By the way, I've always recommended investing in locations where people have got higher disposable incomes and are prepared to and able to and prepared to pay a premium to live there. And these tend to be the established suburbs of our capital cities and the surrounding gentrifying suburbs. And I can hear some people thinking, but all the good land's taken, it's unaffordable to invest in the three big capital cities. Fact is, the way people are living is different today. We're trading space for place, trading backyards for balconies and courtyards to live in inner and middle ring suburbs of their capital cities, which means you don't have to own a home. Townhouses, villa units, low-rise family-friendly established apartments in the right locations can also make great investments. Now, I know there are people out there suggesting investing in the outer suburbs. I'm not really convinced that Penrith or Point Cook or Toowoomba will ever be more valuable than land close to the harbour, close to the water, close to the CBD. Think about it. Where would you live if money was no object? That's where owner-occupiers will pay more, and that's also where tenants are going to be prepared to pay to live there, because not all tenants rent because they can't afford to own property. They rent because of where they want to live. The next rule I want to remind you is demographics drive markets, and that's why I have a weekly podcast with Simon Kirstenmacher. If you don't already subscribe to that after you finish listening to today, go look for Demographics Decoded, because Simon and I talk about the trends that are going to shape our futures. And I think they're more important than the ups and downs of interest rates, consumer confidence, government meddling. Sure, in the short term, immigration is going to be slower in the next little while, but over the long term, understanding the demographic trends will ensure you're in the right property in the right location. And that's why looking at all the data that many of the young new group of buyers agents are using is useless, because that's looking in the rear vision mirror. It tells us where we've been. It doesn't actually tell us where it's going. So the research team at Metropole spend a lot of time looking at where things are going to change in the future. Another lesson I want to share with you, and you've heard me say this often before, so some of this is a recap for regular listeners to this podcast or viewers of this podcast, but please, when you hear something I've said before, why not have a think, Michael, I've heard you say that before, but how am I actually using it in my investing? And the concept I want to share with you is that real estate investing is a game of finance with some houses thrown in the middle. And cash flow management is more important than ever, and having the right finance strategy is important. And it's little to do with interest rates, it's more to do with the correct finance product and setting aside financial buffers, not just buy property, but buying a property to buy you time with the right structures so that you can ride the ups and downs of the property cycle. Actually, I guess that leads to the next point. The economy and our markets move in cycles. One of the most significant trends I've seen over the 50 years I've been investing and being a student of economics is that markets consistently go through cycles. Now, it's a common fallacy that the property cycle lasts 10 years or 7 years in Australia, and some people talk about the 18-year property cycle. Cycles vary in length, and they're affected by a myriad of social and economic factors, and then at times the government lengthens or shortens the cycles by changing economic policies or interest rates. And market sentiment's one of the key drivers of property cycles. One of the reasons why our markets overreact, they overshoot during booms and get a bit too depressed during slumps. Of course, cycles can create opportunities. Remember, each property boom sets us up for the next downturn, but just like each slower phase of the cycle, we're not having a downturn at the moment, but slowed a bit, sets the scene for the next upswing. But it's important to try and avoid being thrown off through well thought out long-term investment strategies by the cyclical swings in the market. It's very difficult to make financial decisions unless you know what you want to achieve. If you don't have a plan, you tend to default to what other people are doing or what the media is telling you. And that's where people get sucked up or sucked in by the cycles. That's why I recommend allowing our team at Metropole to build you a strategic property plan for you, for your family. As I said, we're much more than buyer's agents. We're going to help you bring your future into the present and do something about it. It'll give you direction, results, and more certainties. So go to metropole.com.au and find out how we can help you. And when you do, you're going to find that we're going to, when we eventually do a plan and then one of our buyer's agents helps you to find a property or finds a property for you and recommends one, we use my six-stranded approach and only buy a property that would appeal to owner-occupiers. Not that I'm suggesting you sell the property to owner-occupiers, but it's actually going to be important as this cycle moves on, where the percentage of investors is a bit lower than it normally is. You want the sort of property where owner-occupiers are buying similar properties in the area to push up the value of your property. We only like buying below intrinsic value, and that's why we avoid new and off-the-plan properties, which in general come at a premium, or markets that have boomed for 3-4 years, like the Perth and Adelaide and the Northern Queensland markets, where they're near their peak. We love properties with a high land-to-asset ratio in areas with strong capital growth, where people have got large disposable incomes. And I really like a property with a twist, something a bit unique, different, scarce about it, and a property where we can manufacture capital growth. But the next lesson I'd like to share with you is don't look for a bargain. They really have futures. Even in today's market, there are very few what I'd call a bargain. Sure, there's fewer property transactions at the moment, but having said that, there's a flight to quality and buyers have become more discerning. Look, you may buy a property in a poorer location or in a cheap location, and I don't know, get $10,000-$15,000 off as a one-off bonus. On the other hand, buying in an area that's going to outperform will keep compounding the benefits of growth. Think about it. Properties no one else wants today will probably be properties no one else wants in 5 years' time. I guess you've heard it said before, price is what you pay, value is what you get. So buy the best property you can afford, the type of property you'd be happy to still be owning in 10 or 15 years' time. 2 more lessons I'd like to share with you. One is allow for an X factor. Every year there are unforeseen events, black swan events or situations that blow away your carefully laid plans. Just think back 5 years ago when who would have thought we would have been locked up in our houses because of a virus that came from overseas, from another part of the world? Just look back 2 years ago, who would have thought we would have had 13 interest rate rises or how long they'd last? So every year things happen locally and overseas. And the last lesson I'd like to share with you is take advantage of the window of opportunity. I see the current markets offering a window of opportunity for property investors with a long-term focus. You've heard me say it in the podcast before. I think 2025 is going to be a year of 2 halves. I see the market moving to the next phase of the cycle when interest rates start to fall later this year. In general, looking back over the years when interest rates decline, the market tends to experience a surge in activity. Remember what happened at the end of 2020 when we realised that the COVID wasn't going to kill us all and the economy wasn't going to tank? Buyer sentiment came first. Buyer sentiment returns before seller sentiment and the market moves up. But when interest rates fall, some buyers are going to be able to afford larger loans, and as demand escalates, property values are going to rise, and then buyers who were previously priced out of the market are going to re-enter, and those who sat on the sidelines are going to come. They're going to push properties higher. This creates a snowball effect because sellers who've been sitting and waiting are going to put their properties on the market and the cycle moves on. But here's a lesson I want to share with you. Waiting for interest rates to drop may mean missing out. Throughout last year, despite relatively high interest rates, in some areas properties grew at double-digit rates, didn't they? There are always markets within markets, so while some areas may cool down in the first half of this year, others will experience growth. And I guess this highlights the importance of looking at data-driven insights rather than short-term pressure indicators. So as I said, I think the market's offering a window of opportunity because this combination of factors, strong population growth, a shortage of skilled labour, a massive shortage of housing, inflation's coming under control, soon the Reserve Bank's going to reach its target of inflation, is going to be happy and interest rates are going to fall. And as I said, that's when buyer and seller confidence is going to return. Now, as I said, I see a window of opportunity, but I'm not suggesting you try and time the market. That's just too difficult. Truth, you missed the market bottom. That was in, I don't know, January, February 2023. But if you go back to old episodes of this podcast, we called it at that time, and in my weekly Property Insider videos with Andrew Wilson, we called that too. But my suggestion is if the market hands you an opportunity like this, hey, why not take advantage of it? Take advantage of the upturn stage, the next stage of the cycle when interest rates fall, because that's always created significant wealth for investors in the past. And I still see, well, moving forward, I can't see a change. Demand's going to continue to outstrip supply for some time because we still got strong immigration and we're just not building enough properties, nothing like what we require. And the cost of construction of delivering new dwellings is just going to keep increasing. Not as fast as before, but we can't build dwellings at the price we could before the pandemic. So currently established properties are, well, there's so much intrinsic value because they're so much cheaper than what something new would cost today. So there's increasing rents, shortage of properties. Australia's going to move to the next stage of the cycle. But as I said, rather than hunting down a bargain, focus on buying an investment-grade property in an A-grade location because these type of properties are still in short supply and they're still selling for reasonably good prices, but they're also going to hold their value in the long term. So while it may feel counterintuitive to buy at a time like this when there are so many mixed messages in the media, you could benefit from a time of less competition, lower consumer sentiment, and minimal downside risk. And boy, minimal risk of oversupply that occurred in previous stages of the cycle. So if you want to understand how you can take advantage of this, as I've said a couple of times, why not have a chat with my team at Metropole? Just go to metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I want to discuss with you the concept of, does your situation need to change? Or maybe it's just your outlook that needs to change. Look, I recently came across a story I've heard many years ago, but I did want to share it with you again. You may have heard it too. Two salesmen were sent by a shoe manufacturer to a rural part of India to assess the market potential. And the first salesman came back and he said, "Oh, look, there's no potential here. Nobody wears shoes." But the second salesman reported back saying, "There's massive potential here. Nobody wears shoes." Now, the facts were identical, yet the interpretation couldn't have been more different, could it? One saw a dead end and the other saw a world of opportunity. The stories are simple, yet a profound reminder. While we may not have control of the situation we're placed in, we've always got control of how we choose to view the situation. Let's face it, life's unpredictable, it's full of surprises, many of which we wished would never come our way. At some point, you're going to be thrown into chaos. The sudden loss of a loved one that leaves a hole in your heart, a job loss that turns your financial world upside down, a health challenge that saps your energy or affects somebody close to you, relationship struggles that shake your foundation, or maybe a financial investment that just isn't working out for you. These are situations that can't be avoided. They're part of the human experience, aren't they? But here's the liberating truth. While you can't control the events, you do have absolute control over your outlook. When life seems to be spiraling out of control, you've got a choice. You can fixate on what's going wrong, or you can pause, take a big breath, and look for the silver lining, even if it's hard to see at first. Look, many years ago, I learned the concept of having a useful belief from motivational speaker Chris Helder. It was a very different way of overcoming life challenges. It actually turns to be, it turned at the time, the positive feeling industry upside down with a fresh approach. There were all these gurus telling you about positive thinking. But Chris Helder acknowledged that sometimes bad things happen to good people. And the last thing you want to hear is, "Hey, be positive." Instead, you need to have a strategy to dig yourself out. And his strategy was to look at how you could get a useful belief about a bad situation rather than just trying to think positively. And learning this shifted the way I've learned to solve problems. Sometimes the shift you need isn't in your circumstances, but as I said, in how you perceive them. It's about embracing the power of perspective. So when faced with adversity, the question to ask yourself isn't, "Why is this happening to me?" But rather, "How can I view it differently?" Or, "What can I learn from this? What useful belief can I take out of this?" This mindset shift can differentiate between feeling stuck and discovering new possibilities. The most resilient people aren't the ones who never face challenges. They're the ones who've learned that sometimes changing your outlook is more powerful than trying to change your circumstances. They understand that while they may not have control over the storms that their life brings them, they can always choose how they navigate them. So next time you feel overwhelmed, remember, sometimes the change you're looking for doesn't come from fixing your outside world, the external world. It comes from shifting the way you see it. A new perspective might just be the breakthrough you need. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour. And you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?